if the Fed does have to start cutting in response to something, it may be a series of cuts, and it may be more, extensive than what it seems like it is in the moment. Buyers were more focused on the home price than the interest rate as the cause for unaffordability in the housing market.
The top 13 states in the United States are the world's biggest economy. We have this adversarial relationship with China. Their economy happens to be largely built on providing cheap products to us. In the latest report, I saw that native-born workers gained 830,000 jobs, while foreign-born lost 348,000 jobs. Episode 48 of Market Moves with Mark and Jeff. Jeff, it is good to be back with you today. We have a whole bunch going on as usual. All sorts of current events taking place these days that seem to be kind of impactful on the surface. We got a lot of housing news and charts to be looking at and talking about here. But first, we are at the midpoint of the year here in July, just recording the day before July 4th. And we thought we'd put out some housing predictions here for the second half of the year. Maybe will be exciting.
Well, I hope exciting. It's been kind of fun to look at, what do we think might happen through the second half of the year? I've listened to some predictions, and one of the things I find funny, Mark, is like a lot of the sports talk, like arena. Yeah, everybody will talk about what they expect to happen, but I've never seen anybody go back and audit how good they are. Now, I'm sure that happens, or you could probably find it if you cared to dig in very deeply. But I think it'll be kind of fun to put our projections, and then we'll set a marker at the beginning of next year to see if how far off you and I are, and it probably underscores the statement that this is for entertainment and not investing advice. I'm not even investing based on our own advice and predictions, but I think kind of fun to think about, what do things look like today? Where do we think they'll be in 6 months, and see how far off we can find ourselves.
Jeff, I don't remember if I mentioned this on the last podcast or not, but great book, Super Forecaster, I think is the name of it, that I read many years ago. And they were talking about that it's very easy to prognosticate with kind of incomplete predictions, namely no timelines. So, if will Trump be out as president? Yes, at some point he will, right? No matter what. And so a lot of people put out predictions this way that ultimately will be true one way or another. Will Jerome Powell do something or not be Fed chairman at some point? So we've got some end dates here and some timelines let's kind of see. I'm interested to see if you and I agree on a few of these things.
Well, I am too, Mark. And I was kind of thinking about this and joking that, you might be able to infer something about our personalities and outlook on the world based on which of us, if we have a tendency to be more optimistic or pessimistic on the, what's to come in the next 6 months. But, a lot of these topics that you and I dive into and think about and are researching every week, they're of interest, so that's why we're doing it, right? But what might that mean going forward is kind of an interesting next step for us. So I've been looking forward to this. I think it'll be kind of fun to see if we have any valuable intuition or if it's all just hot air, but there's only one way to find out.
I tend to think about the world probabilistically. So kind of saying, will this happen or not? Yes or no, kind of 100%, either you're right or wrong, black and white. Is not exactly how I see the world. I like to say, well, maybe we're at a 50% chance of this happening and a 30% chance of this happening, and that sort of thing. So this isn't my natural outlook on things necessarily, but forced to choose. It'd be no fun if I say I won't submit an opinion.
Yeah, how do you score a 50% probability of something happening down the road, right? I mean, either it did, in hindsight, either it did or it didn't. But, there really is it's fascinating. We've touched on several different ways that risk assessment, comes into play. That's really what the secondary mortgage market does, is assess risk as they price, portfolios of loans. Insurance is, and property insurance we covered going up dramatically because, they had probably underpriced some of the risk, and so, especially in like vulnerable locations. and frankly, even an appraisal, like when you get down and read the definition of market value, it's an opinion of a probability, of what's the most probable sell price of a property. And so your point resonates with me in the sense that, history is black and white because you can look back and know what happened. But when you're looking forward, it's all probabilistic. What are the chances of something happening or not? Whether it's a home selling for a certain price or a flood event or, whatever else. So it's your outlook resonates, but I agree with you. It's a little harder to look back and score our predictions if we only put probabilities on these events happening.
Well, Jeff, when I from the book Super Forecaster, they were highlighting government programs that were they have found certain people to be very good at probabilistic thinking and weighting tons of data points from tons of different areas, correlated or to come up to some sort of a probability of something happening. And so, to take a current event, I don't think this was the examples in the book, but maybe in 2005, placing to this group of people and thinkers, will Russia invade Ukraine? And so they would kind of go into lab, read a whole bunch on this, and kind of come up with some predictions. And it was useful. Like it's been a government program. I would imagine that it still is on some way. And so, it's people that are really good at taking in a lot of information and sort of balancing what's impactful and what isn't, and thinking about likelihoods based on that. It's really interesting. And we'll talk maybe a little bit here, and I don't know if we could work it into a part of the show. I think you and I would like to, and even be able to create a couple of markets on one of the two websites that's become pretty popular in modern conversation, which is Polymarket and Kalshi, Kalshi. Both of those are sort of putting probabilistic thinking to a lot of world events, and it's interesting, and you can place bets on that, which is always interesting to me because I'm a bit of a betting guy. But one of the funniest ones, and I don't think I've mentioned this on this podcast, I don't think, but Trump suggesting himself as Pope was one of the markets that was on there that you could bet on, and of course it was an enormously unlikely event to occur. But sure enough, in between. When we were popeless for a short period of time, Trump thought he'd be a pretty good one and said it out loud. So those that took the long shot won that, Jeff. Yeah. So and then a little unknown fact about me: I used to, I in fact wrote a book on how to bet on sports back in college, and had a handicapping service after, selling suggestions on how to bet on sports. So this is something I've done for a long time. I don't do anymore. It's been decades now since I've done that, but anyway, yeah, little known fact about me.
Oh, that's awesome. In fact, I know you've mentioned that in the past, but I kind of forgot about that, and I'm guessing that you moved on to greener pastures at some point. But I will say, Mark, that it's probably a pretty safe bet if you have the chance to take a bet on Trump saying something odd and weird and off the wall, like suggesting himself for Pope. I mean, that shouldn't even surprise me at this point, that could be a bet and that it came to pass. We may have to watch Polymarket to see what other like strange Trump isms you might be able to bet on, because there's probably not a bad chance that he'll make them come to pass.
Who knew that from January, when Trump and Elon were celebrating the win, that he would be suggesting looking into deporting Elon here just 7 months later. What a world. What a world.
I don't think I saw that one on Polymarket, but there have been some really funny videos, both of like their bromance and then of their like breakup, and one of the things that AI is pretty good at is making really silly, like images and videos. My wife showed me one of like, it was, of course, AI generated, but of like Trump and Elon sharing a taco together and stuff. And like, and then there's this breakup thing where, they like wrote a song about Elon wanting to fly off to Mars instead of stick around and occupy the White House with Trump. Just funny stuff. But boy, that's been a very high and a very low relationship, and a lot of public fallout. Whatever the end result ends up being.
Yeah, very good. Well, truth is stranger than fiction, no doubt, and I think that makes guessing what will happen in the back half of this year really tough. And certainly, I've been wholly inaccurate over the last 2 years. Did not project things to be as negative as they have been in the general housing market, interest rates, and beyond. So hopefully we'll get something a little better moving forward.
You bet. Yeah, I think we will. And let's jump in and make some predictions and see how far off we can be.
Very good, Jeff. Well, first is rate cuts. How many will we get by the time we look up on December 31st of this year? How many rate cuts will we get? Where are you coming in at?
Well, if I was smart, I think I would just go with whatever the consensus bet is on poly market or something. I think that probably is, we're thinking probabilistic would be the best proxy, but I'm not doing that. And I think, there's a pretty clear consensus that there's an expectation for rate cuts, that there will be something, right? So I'm landing on 2 between now and the end of the year. Maybe gut feel a little bit, but that's what I'm thinking on this one, Mark. I don't know if I got a whole lot of science behind that.
Yeah, I think the thing for me that is difficult to navigate is that I'm fairly optimistic about the economy as soon as the tariff and trade deals are settled. I do think there is a ton of stimulus in reshoring a bunch of manufacturing, opening up new markets around the world in this sort of process that we have here. And we got a decent jobs report, I think, on a few levels that we'll talk about a little later. But inflation has come down some for sure. 2.4%, I think, is kind of the run rate, which is all good. But I'm kind of curious as to what happens when things start to settle and the things that have been set in place to really push the economy forward, are free to start going. It almost seems to me that would be in opposition of rate cuts, Jeff. And so I think that's like it's a very difficult thing for me to consider. I don't know how the market moves with that. I have a prediction here of 3 rate cuts. I think that is the right thing. I don't think that the U.S. interest rate, Fed funds rate, I think it's artificially high. I think it should be settled out at a number of around 100 to 150 basis points lower. And so I think I think everyone views the natural settling point to be, some 150 basis points lower than we are. I'm predicting 3 rate cuts. They've waited a long time to do it. They're waiting for the tax deals to come set. So that is what I'm predicting, is that we'll see 3 rate cuts. July 9th, Jeff, is the 90-day pause of the tariffs, and is kind of the deadline that the Trump administration artificially set. And we just got a Vietnam deal that announced that we'll talk a little bit about later on. So that deal was announced yesterday. A China deal was something we talked about last week, having been inked according to the Trump. So, I think that July 9th, we might see a flurry of these and we might see it settled. So I'm not even ruling out a rate cut in July. Poly market puts that at like a 6 or 15% chance in July. And I think I'd take that bet just because there are good odds there. So, it may not happen, but I think we're going to get some sort of settling of the tariff and trade deal uncertainty. And then I think that will lead into permission for the Fed to cut rates.
It'll be fun to watch, right? I mean, that's kind of the reason we do this, is to make us think critically, what's going on and what might happen going forward that will, dictate what these are. I listened to about a 30-minute podcast with one of the other governors of the Federal Reserve, not Jerome Powell as the chair. I feel like they are trying to be thoughtful in the approach, and the criticism is, that they may be too lackadaisical and just waiting to do something until they have to. But, he made an interesting point that, he could make a plausible case for a strengthening of the economy He can make a plausible case for it kind of holding steady, and the same plausible case for it starting to retreat, depending on what the impact of tariffs are. And he was acknowledging, look, we don't know how many more deals were going to come out, what the impact and effective tariff rates of those deals will be with these different countries. So it was just interesting to hear him kind of talk through the mental exercises that they go through. So, it'd be fun to watch and see. You're saying 3, I'm saying 2. Not a huge divergence there, but at least we're not predicting the same thing.
There you go. There you go. Well, let's move on to amount of rate cuts, Jeff. We're kind of setting in this case a total or an over under of 75 basis points. Where are you coming out on that? Will it be below or above 75 basis point Fed funds rate cut?
I'm going to go with below. I may have to update my notes, but my guess is going to be 225 basis point cuts as far as what I'm projecting on that. I do think, as you were talking earlier, Mark, about, the potential, stimulatory effect, that we might see in the market. It's hard to know. And honestly, I kind of find myself, I can argue one way or the other. It also seems like if the Fed does have to start cutting in response to something, it may be a series of cuts, and it may be more, extensive than what it seems like it is in the moment. Of course, when they were worried about fighting inflation, they ran those up very quickly over a short period of time. If there are problems they're trying to fight, I would expect it to be higher, but I think I'm landing on fewer rate cuts and a lower overall amount, because I'm predicting that there's not going to be major turmoil that they're going to have to try to fight, which would really be on the employment side of their mandate. Now there is some reporting that and we'll get into this, I think, in a bit, around employment numbers and maybe some directions there. If unemployment starts to spike, there's no doubt in my mind would see a lot more than this. I'm predicting that won't be the case, and that the rate cuts will come, but will be kind of tepid through the end of the year.
Yeah, Jeff, I'm going to go ahead and say 325 basis point rate cuts. I think it's possible that they could just come out of the gates with 50 or I mean, in an outlandish. I think it's a non-zero chance. I don't think it's much more than a 1 or 2% chance, but I think it's a non-zero that they could come out and say 100 and do it once, and not mess with a whole bunch of iterative cuts down. I doubt that. I think it's very low probability, but I'll go ahead and say 3 rate cuts of 25 basis points each. So, and I think that would be great if we saw this and it was kind of foreshadowed in the market. And we've seen between yours and I prediction, we're not very far off of what the signal is from the Fed.
Yeah, I think that's right. I mean, it would maybe make for a more interesting episode if you were predicting mass pandemonium and I was predicting euphoria or something, because it'd be a little easier to parse out where that ends up in 6 months from now. But trying to read the tea leaves, however we can, it's interesting to think about. But I think directionally we're certainly aligned, even if by the magnitude is slight differences there.
You bet. Well, mortgage rates as we talk today on July 3rd are 6.73%. We are setting the over-under here at 6%. Do you think we will be above or below?
What I want is for us to be below. What I think is that we will be above still. We've seen some softening, in the last couple of weeks of interest rates, but that's more on the order of 6.9 to 6.73 or something. I do think that the reducing trend will continue, but when I looked at the over under at 6%, my initial kind of intuitive feel was that it's probably a no-brainer. It's not going to move that much in 6 months. Now, I'll admit there may be some recency bias in that prediction because it's taken so long to get any marginal relief of rates. So I'm landing on, I think they'll soften. I don't think they'll be under 6% by the end of the year.
When we had Dr. Mark Calabria on, former director of FHFA, he was talking about that sort of building on itself phenomenon that could happen here, because rates are sort of not artificially, but unusually propped up above the Fed funds rate. We've talked a lot about that having to do with like increased regulatory burden, but even more still, just recently as rates had kicked above 7% and just sort of sat at 7 for the last 6 months. I think a lot of that has been a real uncertainty in the bond market. I don't follow the bond market very closely. But I do know that on Liberation Day, it went nuts, and in a negative perspective, with bond rates increasing quite a bit, and a lot of that seemed to be tied to a lowering of demand of U.S. Treasuries at auction, and they were just having a hard time selling them. I translate that. I don't know if exactly the right translation, but I translate that to a maybe a lack of confidence in of the world in the U.S. financial stability. There's a lot of chaos in this Liberation Day and sort of changing the economic world order one way or another. I think that's settled out a lot. And so if we get settling of trade deals over the next 3 months or 4 months, I think that what Dr. Calabria talked about is what we could see happen is that we see rates sort of stop the huge spread between the 10-year Treasury and the mortgage rate. And so, I don't think we need 75 basis points to get below 6%. We probably could do it even with 25 basis points in the right set of circumstances around. So I'm going to say lower than 6%, becoming the eternal optimist here on the Market Moves podcast, but somebody's got to play that role.
Well, I prefaced mine with, hey, I know where I'd like it to be, but I'm not sure if I see it getting all the way there. But no, I think that makes sense. I mean, we've definitely talked about historic spread between the 10-year Treasury and the 30-year fixed rate mortgage interest rate. I'd love to see that gap narrow. I'm hopeful that it does. It definitely spurs a lot of activity in the market, on the refi and on the purchase side when you get a meaningful move there. A lot of the stuff we looked at in prepping for this, talks about things we've been covering for a long time, spiking inventory, reduced demand, but it's all reduced demand on the buyer side due to affordability concerns. It's not for a lack of interest or desire to participate in the housing market. And so if, to the extent that there's price relief, whether it's home price, interest rate, or a combination of the two, it really seems like is a lot of pent up demand. So I hope you're right. I think I probably am, I guess, is where I land on this, Mark.
There you go. Makes sense. Very good, Jeff. Well, we will turn our attention now to the S&P 500 that is, as of this recording, sitting at 6,279. I don't even know if this is a right number to look at here in whether or not we are setting a total of 7%, of 3%, I'm sorry, and saying, do we think it will be above today's price or below? It is notable that the S&P 500 is up 7% from January 1 of this year, up 5% in the last month, and up 6% in the last 6 months. So, pretty notable. I've also got a 13% in the last year. It's up, Jeff. So, we're really projecting at the top. And as I was about to go public with whatever my prediction is, I was starting to get a little gun shy, just assuming that the S&P 500 was obviously at historic highs, but highs nonetheless. And I don't know. So where are you? Where are you with this?
These are hard to call for sure. I think you laid out kind of the case for, what it's done historically to this point. It is so hard to call the peak of a market. People thought that they had done it in real estate, and people lose a lot of money, trying to call the top and the trough of a market. I think, I'm landing on it. It's going to be less, up less than 3% from what it is today. I think that we will see some continued stability. Now, I wouldn't be surprised to see it spike above that, but if we're talking about where it lands when we're looking up at the end of this year, I am thinking that it's probably not going to be more than up 3%. And with the historical setup that you gave, we could have maybe set that at 0. Do you think it'll go up or down from here by the end of the year? I wouldn't be surprised if it was, if it was up some, but these things move a fair amount. 3%, isn't all that much of movement, based on what it's done in since beginning of the year and over the last 12-month time period. But I'm saying less than 3%. Mark, what about you?
Well, Jeff, I've got to steel man and play the part of the optimist here, and I am going to say over 3%. And you know, what I have observed, and I mean, this goes back to government stimulus in the great financial crisis. I mean, you know, kind of all the way back to 2008 when I was like, you know, meaningfully participating in the economy and kind of watching things. It feels to me like we have just had a couple of a decade trend, certainly beyond, you know, just one presidential term, but just sort of a, you know, the offshoring of manufacturing. I don't know, just a negative trend towards business, and it's felt that way for me for a long time. And on some level, I feel pretty optimistic with the changes from a business perspective and a business environment. Reduction of regulatory burden, you know, the reshoring we talked about a little bit earlier, opening up world markets that have been closed to the U.S. forever, like never have been really open to the U.S. and on and on. It seems like there is, you know, even the multi-trillions of dollars of promised investment into the U.S. that is already in action and moving. You've seen a lot of like small anecdotes of that making major differences to American industry one way or another. And so, you know, I'm kind of buying into a boon for a while. As soon as things get settled, the hard part is over and through. So in that way, despite us being at highs, I'm saying, man, you know, there's a lot of good still to come here and to hit. And if you get lower interest rates, now people are, and I think this is part of the reason in why Trump is so frustrated. Howard Lutnick, who you hear talk about this a lot, I think their plan was, you know, multi-pronged, but it was assuming that rates got better. Well, they need rates better because there is a lot of opportunity that has been created over, you know, at the beginning of this year. People need to borrow money to go build factories and do a whole bunch of things. And so if rates are high, that makes it harder to do. So I think making capital more accessible is one of the things that's frustrating them because they need that to make this happen. So, you know, I don't know if it will happen or not, but I think there's a lot of things moving in the right direction that have me optimistic.
Well, that makes sense. And again, you know, it's what do I think versus what, you know, do I hope or would like to see, you know, take place in the market out there. And it, you know, like I said before, it's hard to call the peak of a market. I remember in 2014 or 15, you know, we'd had a sustained 4 or 5 year recovery in home pricing. And I was feeling like, man, anytime things are going to start to, you know, to correct or soften a little bit, because we've run up for 6 or 7 years at this point. And I was off by a number of years. And, you know, even now, and you know, the pandemic and the stimulus and all of that, I think kind of perpetuated what had been a historic run up in the pricing. But it's just hard to know what, you know, how all of the influences will converge to, you know, to impact things. But I think you make a reasonable case that it certainly could be up more than the 3% that, you know, up over 3% from where it is today. So I get where you're coming from on that too.
All right. Fannie Mae stock price, something we've talked a lot about here. It is today at $9.51 on July 3rd. And we are not setting a total here, but just a general prediction on what that stock price will be doing. The market moves trade has been, it was up 3x. I think a lot of folks that have been in this stock for a while think that $25 or $30 a share is possible. So you've got, you know, a 2 or 3x run from here. What do you think?
Well, I would be long on the stock. I think it will. I think it'll continue to go up. And you know, from you referenced having Dr. Mark Calabria on the podcast earlier. That was one of the things we talked in depth about was, you know, Fannie Mae and Freddie Mac and privatization and some of the potential barriers or likelihood of that happening. I think that it's not going to happen, you know, in the next 6 months. I don't see the GSEs being privatized. But I think as it gets closer to that being a likelihood, that there will be an anticipation that that the stock price will go up. I think that it will. And so, you know, you talked about the market moves trade being up multiple times. And I think writing that trajectory or that trend, I'm saying, yeah, I think it'll be up, by at least 10%. As maybe that's optimistic. It hasn't been a straight up. It's definitely been choppy, and it's retreated some based on the headlines or whatever, the FHFA director Pulte says, or even Trump says about the possibility or the likelihood. We want to make this happen, and there seems to be some optimism, and then it seems to retreat a little bit as it falls out of the limelight. So I'm saying up by 10%. I think it'll continue the market moves trend of upward over time.
Yeah, very good, Jeff. Very good. Well, my prediction is that it'll remain even throughout the rest of this year. We kind of got the go-ahead announcement from Trump a month or two ago that we are going to move, or he instructed some people to think that or start talking about making it private. I do think if it's going to happen in this term on some level, it's a long runway to get it done on a number of fronts. I think they got to figure out how the balance sheet supports these two entities private. They've got to iron out the government guarantee and what that looks like when it were to exit. And there's going to be a lot of people that are opposed to that government guarantee. So there's probably a lot of political debate that would need to happen. It does look like Bill Pulte he's certainly not taking the seat to just sort of manage instability, right? There is a lot of glass breaking and sort of bold action, even controversial action, including daily berating of Jerome Powell. I see a lot of people in the mortgage space happy and unhappy with that. So the announcement kind of has been there. I think the announcement of the intention, there's a lot of moving parts. If it's going to happen in or around this president's term, I don't know. They got to get going, but it does seem that this administration is busy doing a whole bunch of things every which way. And so I think it's going to take some time to develop. And I think what needs to develop is what this darn thing looks like on exit, or how the exit occurs. And I think investors are going to need that one way or another, Jeff. So I'm saying we've kind of gotten the news for now, and it rose on a lot of that. So I think it sits for a while until we get some clear stuff. And I just think there's a lot on the priority list that's above this for now, and real work that needs to be done until we get meaningful kind of pathway to see.
Yeah, that makes sense. And it depends on where, upon privatization, it settles out. I think it'll continue to trend that direction as it seems inevitable that it moves that way. I've heard Mark Calabria talk in several different settings that, hey, this conservatorship thing is supposed to be temporary, not permanent. I think that the Trump administration has the will to actually move it out of this conservatorship, and I think that the price will reflect getting closer to that point. But I also agree with you, Mark. There's a lot of hard work to be done, and it's not a short timetable for that actually being finalized in any means.
Okay, well, Jeff, we don't need to show it necessarily, but we do have a screenshot of the Polymarket percent chance of this ridiculous thing occurring, which is Chairman Jerome Powell. Will Trump remove him in 2025? That one, not fun for Chairman Powell, but fun to opine on with all of the drama. It's a lot like a daily soap opera. Watching and sort of a little ridiculous, I think, for the the sophistication and integrity of the position and the role. It's a very serious banker's role, and Trump and Pulte particularly are turning it into more of a soap opera, which I don't really know what to think about it. It does sound to me like they will be announcing the next Fed chair pretty soon. And I'm sure that is kind of trying to create a lame duck situation with Jerome Powell. We have, at the time we're recording this, I think, I've not looked into it beyond headlines, but what I think is probably a ridiculous kind of fraud or perjury allegation on some $2.5 billion headquarters thing. I can't imagine any of that is real, but I don't know. Maybe I'm sure someone will send it to me if it is. But so there's just a lot going on, and I've seen a bunch of congressmen reply, "Yeah, we'll look into this," and there's just pressure on pressure on pressure. And so I'm going to say that Chairman Powell is not the Fed chair on January 1. I think we even got a Supreme Court ruling that Trump could remove him, which I was very surprised by. It just feels like a little bit of what is the Trump strategy, the art of the deal, shock and bore. I feel like we've been in the 3 or 4 month shock phase of, I might remove this guy that I'm not allowed, that is totally independent and I'm not allowed to remove. Only by the time that he were to do it, it would be seen by the public as sort of boring because it's been mentioned. Yeah, you said you were going to do that 10 months ago and every day since. So I don't know. I sort of hope not. I don't think I want that to happen, but there we are.
Yeah, it's been interesting to see this drama unfold, and I'm going to take the other side, but I did put a caveat here, Mark, that I think he will still be the chairman on January 1, but I don't have a whole lot of conviction around that. And one of the other possible outcomes is simply that Jerome Powell says, "Hey, this is not a whole lot of fun, being in this soap opera and this high pressure, situation. There's no reason he couldn't resign, at least that I'm aware of. Now, he's stated publicly in the past that he's not going to do that." So there's more than one reason or off ramp for him, out of the, being the Fed chair. It sure doesn't seem like it's any fun being in that role right now with the constant badgering, from the president, from the FHFA director, and now, presumably, Congress, maybe looking into, allegations, maybe not. I don't know how that'll all play out. And of course, if there has been, something inappropriate done, then they should investigate and take appropriate action. But it's just interesting. I think that you shared something with me, Mark, talking a little bit about, at least allegations that the Fed had dropped rates ahead of the election in kind of a political move to try to gin up the economy and the market, as a potential aid to Biden. I don't know that we'll ever really know exactly if there was some political motivation or not to doing that. That the timing is what it was. As I think back over the prior Trump 1.0, it was the same thing of Jerome Powell, the rates are too high, drop the rates. And now he's living through this again. I wouldn't be surprised if he wasn't real thrilled to have Trump win the election, kind of anticipating that this was going to be what he would have to, fight on the tail end of the chairmanship. Now, that's not to say that I know or even necessarily believe that he moved rates for political reasons, but it certainly seems like this role is being politicized, with just the constant keeping it in the limelight, based on the different motivations of the presidency.
Yeah, I think it's a good point, Jeff. And I think Powell took this job. It's got a lot of power and prestige to it for sure, but I think he makes under $200,000 a year. I mean, this is not a guy that's like, living on yachts and all of this. And I think he even commented that he thought his salary was very fair for the job and whatnot. So this does not feel like someone that would lavishly build out a headquarters or even know what to do with all of that money. So that doesn't seem to have any staying power. But I do think, it's unprovable. And I don't know if there would be anything to prove or not. But I do think there's been a lot of reason to lower rates, it seems to me, and certainly much more today than there was when they last did it last year. So I don't know. I think there's more to that story, and there's a lot of reasonable explanations too. So we'll leave that there. You are a yes. He will still be the Fed chairman, and I am no. It's going to be blasted everywhere. I'm almost embarrassed by the prediction.
I'm not certain what to expect there, honestly. There's just so much drama that we'll see. I wouldn't be surprised if you ended up getting this one right when by the end of the year.
Well, I think a $10 bet would return me something like $70 or $80, right? So I don't know. Somehow we're going to figure out how to make some of these accounts, Jeff, and share the bets we make and see how we do. So then the very last prediction, I've liked this prediction thing because it does give us what I was talking about the super forecasters doing is taking a lot of different data points, synthesizing them into kind of a decision one way or another, and at least gives us a platform to kind of talk about some of those data points that we heavily weight or don't heavily weight. So I've appreciated the exercise of doing this. And the last prediction is home price. Should be right up our alley, and I think probably you and I are going to be the worst at this. But as of this recording, Redfin in their U.S. housing market data page is suggesting that the median home price is $440,913 as of this recording. Where do you think we are with median home price?
Well, I'm going to take, and I don't know if we've really set an over under necessarily, but I'm going to say we're down at least 1% on a median basis. Now that would be annualized at a 2%, rate of reduction for the median home price. It was interesting. I think it was the CEO of Redfin had made some headlines the other day, predicting a turning of the course and a modest, a couple of percent price reduction in home pricing coming up. And I'm not necessarily basing my prediction on what he said, but as you and I have covered kind of in depth, and many might argue ad nauseum, the trends that are taking place with increasing inventories and decreasing buyers in the market. If that trend continues, I think that even if we get improvement in interest rates, there may still be some downward pressure on home pricing. We've touched on many times, but the buyer survey suggested that buyers were more focused on the home price than the interest rate as the cause for unaffordability in the housing market. And so, I think in my mind, a lot of data points to say I'm not predicting it falling off of a cliff, but I do think it trends lower from now through the end of the year. Now, honestly, Mark, I hadn't even thought about this till just now, but last week we showed a chart that really reflected the seasonal nature of the pricing in the market. And so, if I'm right, it may simply be that I'm writing the seasonal trend more than a kind of a structural change in the market. So that's what I'm going with, and maybe I'll be right more by dumb luck than good intuition.
Yeah, Jeff, I'm going to say even. I think a number of my thoughts here are a little counter to the public or popular narrative, and I'm okay with that, and I'm okay with being wrong if that's the case. But I think that the public, I think there's a ton of economic uncertainty that I think is easing on some level. We have data to show a little bit of that. I think that what we've really been dealing with is, in a lot of ways, is the shock of interest rates rising so darn quickly, and the recent memory of how much it costs to buy this or to own and pay mortgage on this house just 2 years ago. And I just can't stand the fact that it's costing this much more to get in. And so I think if we get interest rate relief, which I think we will, then, I think that there is room for the housing market to sort of stay steady here and start soaking up some of the inventory that's hit the market. So, there is so much pent up demand in and around the entire country, and it's here for 5 years. We've seen, you and I have shared charts in kind of our show text chain on this, that the average mortgage months old is increasing, as you would imagine, because people are just sitting there doing nothing. Many can't afford to do that much longer, or really holding their nose to do that, so they want to do something. So, I think that we're going to have demand hit at some point in a way we haven't seen for a while when we get some interest rate relief. So I'm going to say even.
I think there's a reasonable case that you're making on that front, Mark. It'll be fun to track and to watch. I kind of feel like, oftentimes it's easier to predict a marginal minor change, and sometimes, there can be momentum, whether it's from psychology in the market or just out of balance, market factors where things move in a more dramatic way than you expect. I don't feel like, my tepid prediction of 1% change is really stretching necessarily, but it'll be fun to watch and compare notes. I already look forward to the episode where we recap, what these predictions are and, what we got right. And, one last point on this topic, that I referenced that interview that one of the other Fed members had talked about in their podcast, and they said, one of the things they've observed is that, when you look at the most recent really significant financial crises that have taken place, and a lot of them have been brought on by some sort of a black swan event or something that just wasn't anticipated. It wasn't just like the already known knowns of, market factors and forces and stuff. And so, there be something that happens in the next 6 months that, really throws a wrench in this, always a possibility, of course, but I guess our predictions are kind of inferring or assuming that there's not going to be some, massive change. And, there are some political wins. I mean, some things going on. Something could, flare up in in Taiwan, who knows what happens with some of the other brewing conflicts already, if they'll settle down, which I think is kind of what we're assuming. That I think our predictions maybe make more sense. But a lot going on out there, and maybe that kind of pivots or transitions us into a few of the other topics we wanted to touch on, beyond just prognosticating what we think the future holds.
Yeah, Jeff, boy, so much to run through. I'm not sure we can get it all in. We've talked kind of at length with on the political front of the Pulte and Trump pressure on Powell. That is clearly a strategy by both of them. I wouldn't be surprised if it isn't coordinated with the recent stuff of like trying to investigate some sort of like fraudulent spending or not being truthful in testimony, Senate testimony. I don't put a lot of weight in that, at least with what I know now. We did get the announcement yesterday of the Trump tariff deal. And Jeff, I see, let's go ahead and pull that up. I think it's a really interesting chart, and I think this is sort of behind the Trump administration's desire to rearrange or change the tariff deals or introducing tariffs. If you could share this, yeah, great. So I thought this was fascinating. So this is essentially saying, and this is the knowledge how dominant the U.S. market is in terms of GDP in and around the world. The top 13 states in the United States are the world's biggest economy, and they are bigger than, of course, the second largest economy, which is China. Then the blue states here on the map, and for the audio listeners, the next 10 U.S. states are the third largest economy in the world. Then the fourth largest economy in the world is the remaining 28 U.S. states, followed by the fifth largest economy in the world, which is the German economy. It's amazing how important we are in terms of size and gross domestic product activity. And, I think a lot of this has funded or has informed the really bold strategy. And I think an assessment of the cards that the U.S. holds. Now, I think there's a great argument of whether or not we should have played them, or we should play them. Just because you have a strength doesn't mean that you should play it. And we are certainly doing that in spades. But one thing that you see, and I think this Vietnam deal, I think it's sort of amazing that this is the case, but you could understand how it would be that U.S. products were not open to the Vietnamese market. I think this is the case, Jeff. Do you understand it to be that way?
Yes, that's the way I understand it, although I'm not terribly well versed in it, but I do think that's right, Mark.
Well, whether it's true in Vietnam or not, it is definitely true in a lot of major markets around the country or around the world. And, this Vietnam deal is opening up the Vietnamese market at 0% tariff while charging like a 20 or 30% tariff for Vietnamese products coming in. And it's also, I think, an important criteria is a lot of the Chinese manufacturing was, I forget what they call it. It's like transshipping or something. But if China has a huge tariff, they just send it over to the Vietnamese shore and then send it from the Vietnamese shore over to the U.S. And now it's a Vietnamese shipment coming in, and you can bypass tariffs. And so they've tariffed the transshipping situation. So I think it's a big deal, and the more of these getting done, I think this is a leverage move kind of on China and others that are providing. I think India would be the same. So movement ahead of January 9th or July 9th. But I'm hoping that we get some settling of this issue worldwide come July 9th.
Yeah, well, I mean, this chart really serves, I think, to drive that point home, Mark, of just the strength of the negotiating position, that the United States is in. It's always interesting to, see things like this that kind of paint a different perspective or a broader perspective on, where we're coming from. It's fascinating and definitely interesting. I did a quick search, while you were talking, because you hear that like California is, a significant. I mean, it's an economy unto itself, right? And so Gemini just told me that the California economy and GDP just surpassed that of Japan, which is just crazy to think about, right? But
Yeah.
you don't even need, a majority of the states in the US to constitute the world's biggest economy. Now, China certainly has been growing and continues to grow and that sort of thing, but kind of remarkable that we have a deal supposedly, inked and in place there. I suspect we may get some more, details coming out of that in the coming weeks, but just fascinating to see the relative size of the economies as we're talking about. It kind of stands out that Germany is like the lone economy of any, or at least in the top five of anything in the European Union. And China is the only one, in the east part of the world really that's on par. So fascinating, kind of fun to see what what the impacts are here.
Yeah, and that is the such an odd situation that I think was endangering the U.S. on some level. We have this adversarial relationship with China. Their economy happens to be largely built on providing cheap products to us, and with this strange tariff non-protection of IP, it's we are funding the continued growth of that. Maybe potentially to our detriment. I hope that's not the case, but I think all of this is addressing that, and we hold a lot of power given that a lot of their economy is sending stuff overseas to us here. So I guess Americans keep buying one way or another. So yeah, good stuff. Well, Jeff, I was going to turn to payroll information. We got payroll numbers generally. The ADP. This was interesting on a few fronts. The ADP employment was much worse than expected. And I thought that was notable. So the ADP payroll was negative 33,000. The estimate was 98,000. That's a big lowering of new jobs one way or another. But I wanted to highlight something that I saw just before we came on to this podcast. And we have talked a lot about, and not really having great information on, but we've talked a lot about these odd positive new jobs numbers that we were seeing all over the last 4 or 5 years, and just was not matching what you and I were feeling. I think it's easy to write that off and say, well, we're in real estate, and real estate leads the country into a recession, leads it out of it. And so maybe we're just leading people in. And so our world is kind of walled off here. But we noted that a lot of those job increases were government and academia. And we had seen that on a lot of in a lot of instances. Well, and then a lot of foreign-born jobs we had 20 million people coming into the country, and I don't know if that was part of that that phenomenon or not, but it was kind of tied to those things. Well, in the latest report, I saw that native-born workers gained 830,000 jobs, while foreign-born lost 348,000 jobs. That is in direct contrast to the trends that I had seen over the last couple of years, and pretty darn notable. I think you could trace some of the current events in initiatives that we see in the headlines as to maybe explanations of that. But there is a real shift going on a whole number of fronts.
Yeah, there really is, and observing, what that impact, is now and maybe going forward is, it's really pretty fascinating, Mark. When you shared that, my initial thought was, well, geez, that really stands out. Is it all of the deportations that are being done? And honestly, I had meant to look and see like what the numbers were. I saw a headline, and I'd have to go find it now to reference, but something suggesting kind of net zero migration, like net migration, at least trending that way.
Yeah.
It's interesting because as we talk about the employment rate right now, unemployment is very low. Now, as you had said, just a second ago, we had a net job loss where a net job gain was the expectation or what was anticipated, in the space. But if we're really going to re-onshore a whole bunch of new jobs, and further stimulate the economy, we got to have people to fill those jobs, unless the expectation is that all of this onshoring of manufacturing is going to be done in a completely automated way. I don't expect that to be the case necessarily. And so interesting to see how much is the rate of increase for the domestic born workforce, but it sure feels like we're gonna have to add to it a lot more than just kind of natural birth rates are taking place in the country to be able to keep up with that, given that we're already in relatively low unemployment territory as it is.
Yeah, you bet. Boy, yeah, it's a lot of moving parts here, and it's interesting to watch. You had a graph up, Jeff, that I didn't get to cover, but this was disappointing, I think, to see with regards to the payroll data that was just coming out, and it is that government payroll has increased by a large amount here in the last month, and it's not what we want to see. It maybe is a sign that whatever Doge was trying to accomplish has sort of faltered. We see a lot of bombastic headlines on that, and so I don't even know what this means. I don't know where government employees would be hired or put in place right now, but it does seem like that is kind of going in the wrong direction.
I don't think this is what actually happened, but I wouldn't put it past Trump to go on a government employee hiring spree just to spite Elon, based on the public fallout that there's been. I mean, you mentioned like him floating the idea of deporting Elon as crazy and bombastic as that is, but on a little bit more serious note, I think that's right. I mean, I think there was some optimism around, cutting where needed and allowing for an actual shrinking of the government expense, and this all circles back to the credit risk and the financial stability of the country. And if we're not taking meaningful steps to shore up or to be on firm financial footing, I don't think that's a good recipe for interest rates. As predicted earlier, we think they'll go down in the short term, but you really got to be in a strong financial place long term to have affordable and sustainable interest rates that are on the lower end of the spectrum. So, I'm disappointed to see that as well. And that's not to say that there's anything against individuals that work in the government, but you just can't employ more than you can afford to employ, whether in the private or public sector, at least in my mind. Certainly not over the long term. So, maybe that's a blip, but I don't have any data that suggests that that's the case.
Well, Jeff, I think we should boundary ourselves with a hard cutoff of an hour in here, and we are getting close to that. We've got lots of good data on U.S. mortgage to income ratio, like historical analysis, purchase apps up a little bit, and many others. But I think for now we can leave that and talk about it as we get time.
Yeah, I think that makes sense for sure, Mark. I would be surprised to see how many actually endured this long with us, as it is. You and I enjoy this. It's fun talking, tackling these topics, thinking about what's going on and how do all of these currents kind of intersect to influence each other, and what impacts do they have in the spaces where we operate. So it's been a lot of fun. I've really enjoyed, like you had said, the exercise of going through these predictions. Look forward to seeing how wrong we are in 6 months from now, but it definitely causes us to be paying attention to what's going on out there. So I really appreciate it.
Well, as we're recording this, happy July 4th to all of the listeners. And as you're listening to this, hope you had a good one. Till next time.
Very good. Thank you.